You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy end of the month Friday, everybody. This Friday marks the end of July. And as we walk into the historically worst 2 months of the year for the stock market, which is August and September, they tend to be the worst 2 months for the year on a historical basis. Today we're going to be cutting through the confusion and explain the difference between two main types of investing, which is tactical and strategic. Now stay with me. I promise that this is probably sounding boring to some of you, but I promise you'll walk away from this episode more educated than you were before you started listening today. Now, if this is the first time that you've listened or watched us, thank you so much for joining us. The Cash Podcast is produced weekly, and I want you to feel free to come back often, subscribe on both YouTube and iTunes. We're on both. And last but not least, since I'll be sharing some visual aids, actually several, looks like we have about 11 visual aids today on this episode, please note that all links, visuals, charts, and other educational resources can be found on our website at libertaswealth.com. All right, let's go ahead and just get started here. First of all, before I even start, this is kind of funny. I have to admit that I recorded this entire podcast today, and because I'm colorblind and I can't tell the difference between red and green, I had no idea that my mic had somehow been tripped to mute. So I got to the end of the podcast, thought I was all finished, ready to upload it. Gina was pass it on to Gina and get it uploaded to YouTube and iTunes. Of course, I couldn't because it was just me talking and a bunch of mouthing with no words coming out of my mouth. So kind of crazy. So anyway. Okay, well, let's move on here. So first thing here, a quote: hope is not a strategy. And the only point I want to make here, I love quotes, is that investing in your future through your 401k, through IRAs, Roth IRAs, whatever it is, whatever investment vehicles you use, should not be invested without a retirement plan, without any destination in mind, and to hope you make it on time. So nobody ever said that it was possible to get to retirement by just kind of guessing your way through it. So we always want to have a destination in mind, and that's the way we're going to start today. We're going to start with the end in mind, which is none of those things you're about to learn today on this episode matter if you don't have a financial plan, unless you're so filthy rich that it doesn't make a difference anyway. And that's not most people, obviously. So what we're going to talk about today is the difference between tactical investment management, or trend following, using technical analysis, and strategic asset allocation, or what I like to call fund strat, which is like fundamental strategic asset allocation. Both are fine strategies for the right people. The difference between the two, there's a few differences, there's a few similarities. We're going to go through them, but it really depends. What strategy makes the most sense for you depends a lot on your personality, your age, your tolerance for risk, and how much you're willing to see your portfolio go down in value, say in the short to intermediate term time frame, or how much you can afford to see it go down in the intermediate term time frame. Many times when markets crash and things don't go our way, it can cause some of us, depending on our personalities, to want to abandon our retirement plan. And obviously, there's any plan, you can spend hours and hours, and we can update a financial plan, retirement plan, estate plan on an ongoing basis. But if we don't follow the plan, then that plan is obviously worthless. So the first thing I want to do is explain to you the similarities between the two strategies, which, to make it simple, I'm going to use an analogy here. Both strategies aim to invest in what we'll just call the leaders, or the strongest investments. And the leaders, looking at the screen, for those of you listening on iTunes, what we're looking at is a playoff bracket for Major League Baseball, so the MLB playoff brackets. And the easiest way to explain strength in the market, or we'll call it relative strength, or RS for short, the easiest way to explain both of these strategies investing in strength or in leaders is to say that when we're investing in our retirement portfolios, we don't want to invest in every team in Major League Baseball, because that would insinuate that we're investing in the best teams, the worst teams, and of course, everything in between. What we want to do is we want to analyze the stock market, the bond market, the commodities market, and we want to say, okay, what are the best investments over a certain look back period? And let's stay invested in the ones that are performing the best as of late. Because the studies say that the investments that have performed the best over the last, say, 6 to 12 months, and there's lots of ways to calculate this, have a tendency to perform the best over the next 6 to 12 months. Furthermore, the investments that perform the best over the last 2 to 3 years have a tendency to perform the worst, or at least underperform, over the next 2 to 3 years. So what we want to do in our investment portfolios, if we pictured it being like baseball, is we want to invest our money in the playoff teams, understanding that there's going to be 2, 3, 4 years maybe where similar or some of the same teams go back to the playoffs over and over again, and then eventually some of these teams are going to stop going to the playoffs. They're going to end up the laggards. They're going to end up the teams that don't do so well, and we don't want to invest in them anymore. We're going to call that, you can call it team rotation in this example, but that's sector rotation, asset class rotation, industry group rotation. So if the Indians back in the 90s were a good team for a while there, but then they went to playoffs a couple of years, and then they lost all their players and went to other teams, so they just didn't make the playoffs anymore. So if baseball teams are investments, we want to stay invested in the playoff teams, which are the best investments, again, over a certain look-back period, all depending on what look-back period you're using. So again, that's the similarities between these two strategies, so we can put that aside. They both invest in leaders. They both aim to take advantage of growth and relative strength, or again, RS for short. Now let's talk about the differences. First and foremost, strategic. So strategic investment management is going to stay invested to a target depending on a risk-reward profile at all times. So an aggressive portfolio might be invested at, say, 90% stocks, and that might be 80% U.S. stocks, 10% international, maybe some commodities and cash, and that's it. A balanced portfolio might be invested at 80% U.S. stocks, 10% international, 30% bonds, 5% gold, maybe, 5% cash. But basically, as you get more and more conservative, obviously less money is targeted into stocks or riskier assets like commodities, and more money is targeted at a certain percentage to safer assets or perceived safer assets, such as bonds or cash. So that's the first thing about strategic. So if we look at a portfolio, and for those of you on iTunes, what we're looking at is one big pie chart here. A strategic investment management strategy is static, meaning there's very little change. There's minimal change. And the change that does occur, because when I say minimal change, I don't want to say there's minimal change to the investments. There's lots of change to the investments. There's minimal change to the allocation, because if we own a balanced portfolio that has a target of being invested in 50% U.S. stocks, 10% international stocks, 30% bonds, 5% cash, 5% say commodities, in this case let's just say gold, then that might change over time. So that might change because the market goes up, the market goes down. That might change because bonds go up, bonds go down. But it also might change because, let's just say, even though gold is performing really well right now and we own gold, there's going to come a point where, if we go back to that Major League Baseball example, that if gold is one of the teams we're investing in and they start to underperform, we want to take our profits, walk away, and invest in something else that's doing better. In other words, one of the leading teams that's come into the playoffs, and then sell that money, or sell the investment that we owned, that we had our money invested in, that was in the lagging investment that's now left the playoffs and that isn't playing so well anymore. The same as well in the case in the stock market. If the stock market's doing well, we may be invested in things like technology. We may be invested in semiconductors, things like that. Maybe we're invested in AI. Maybe we're invested in online retail, things of that nature. Market starts going down, maybe this rotates out of things that are more offensive and rotates into defensive investments such as utilities and high dividend paying stocks. But the point is, with strategic asset allocation, there is minimal change and in terms of how it's allocated, and it's going to stay static with regard to how it's allocated, but the investments are going to change inside the allocation. So that's the first difference. So strategic, invested to target, regardless of the model, just maybe more stocks, more bonds, less bonds. Tactical, and that's the next slide we're looking at here, we'll still have an allocation. There'll still be a target allocation. So that same balanced model might be invested at 50% stocks here in the U.S., 10% international, 5% gold, 30% bonds, 5% cash. But what might happen is that because the risk-reward environment in the stock market, whether it be because of a coronavirus pandemic or otherwise, whether it's the mortgage crisis, the dot-com bubble, whatever the reasons are, really are irrelevant. Whenever the market starts to show signs that it's getting weaker and it starts to crash, and risk levels are so high that we might be faced with a catastrophic, life-changing stock market crash, that's what's different about a tactical strategy, is that it will start to sell stocks altogether. So in other words, it's not static. A tactical portfolio invested in a balanced portfolio like the one you're looking at here on the screen, if you're on YouTube, could be in a crash environment, could be invested at 55% bonds, 40% cash. It could be invested at, say, 90% cash in money market. If even an aggressive portfolio. So here, for those of you on iTunes, what we're looking at, and again, all these slides are on our website, by the way, if you want to come back to them later and check them out at our website's libertaswealth.com, and you just click on education and go to podcasts. But anyway, so what we're looking at here is 3 pictures. We've got offense, where our portfolio in an aggressive model might be invested driving metaphorically at 90 miles an hour. In this case, I'm saying 88 miles an hour. If the market starts to get neutral and it's not offensive, but it's not defensive, it's somewhere in the middle, we take our foot off the gas and maybe being a little bit more conservative. And if it's on defense, if things look so bad out there that it just doesn't make sense to take risk in stocks, then we might be driving at 29 miles an hour or even slower perhaps, because we have no stocks in the portfolio, we have some bonds, maybe a bunch of cash, so we're just taking less risk. So again, that's the difference between the 2 types of strategies. Call it a 30,000-foot view. Pros and cons. So the pros and cons of trend following are this, very simply. Tactical investment management works very well in a bull market when it's going up. And by the way, bull markets are called bull markets because they attack bulls attack with their horns from the bottom up. Bears attack with their claws from the top down. So tactical works really, really well in a bull market. It also works really well in a bear market because when the market's really unhealthy for a prolonged period of time, it gives us the ability to protect our money, protect our capital, and avoid catastrophic, big, huge drops in the market, like the one we're looking at on the screen here is the 2007 to 2009 mortgage crisis, when the market went from top to bottom down about 58%. Where tactical investment management struggles, however, is during what we call whipsaws. This is where the market goes down so fast and comes back so fast that we end up selling on the way down the hill and then having to pay higher prices to get back in. And what that does is it creates a short-term or intermediate-term lag in performance, as opposed to just staying in the market the entire time, playing no defense, and just kind of leaving your allocation as it is, assuming the market's going to come back this fast. Of course, we don't know until it's over, until we have hindsight at our advantage. But those are the pros and cons. Works well in a bull market. Tactical works well in a bear market, but it does struggle. It doesn't do so well during whipsaws. Strategic investment management. The pros, the good thing is that it works well in a bull market. So what you've already learned is that both tactical and strategic do well in an up market. However, strategic investment management, because it does stay invested to target in whatever the model is, whether it's aggressive or conservative, it stays invested to that target percentage, whatever it is, in stocks, bonds, and so on. So what ends up happening is strategic asset management or strategic investment management tends to struggle during down markets because there isn't any risk management. There's not an attempt to try and avoid the downside. So you can see on this picture here, this is a diversified portfolio of large cap stocks, mid cap stocks, small cap stocks, international, domestic, real estate, and bonds. And when the markets go down, everything kind of tends to go down together. Now, it's not perfectly together. Oh, market just closed. It's not perfectly together, but you can see here the bond market is the only thing that would have created any sort of diversification or safety in a portfolio that is diversified across a bunch of asset classes. But that also speaks to the fact that we obviously want to stay invested in the strongest asset classes or the strongest investments, not just have money in everything. So the last thing is, and this is another pro or a benefit to strategic asset allocation, is that there are no whipsaws, because in the times when the market goes down really fast and up really fast, we wouldn't have gotten out and we wouldn't have had to pay higher prices to get back in. So while it might make a whole lot of sense to be in a tactical portfolio when markets crash, because we have a prolonged, unhealthy market, there's times when the market looks like it's going to crash, but it doesn't. And in hindsight, with strategic asset allocation or strategic asset management, there are no whipsaws because there was no attempt to get out of the market. So in closing today, just want to kind of go back and forth, just summarize everything we just talked about. Again, both tactical and strategic, both invest in the strongest asset classes, sectors, and industry groups. They both do that. Both of them work well in a healthy uptrend. So in the markets, in a bull market, a healthy uptrend, they're both going to do well. However, where the differences are again is that tactical investment management works well in a prolonged unhealthy downtrend or market crash because it implements risk management first. That's the goal. We want to first and foremost avoid crashes. This is as compared to strategic, which does not work well in a prolonged unhealthy downtrend because there's minimal risk management to speak of, with the exception of rotating into maybe safer investments like dividend-paying stocks, but they're still stocks, and when markets go down in value and markets crash, well, it's like the tide going out. Everything goes out with it. And then lastly here, tactical can be frustrating when markets move fast, whereas strategic, it doesn't matter if markets move fast because, again, you're not getting out anyhow. But at the end of the day, when you compare these two strategies, every investor is different. Some people, depending on your age, your personality type, your tolerance for risk, how close you are to retirement, whether you're already retired. Some people might make sense for a tactical. Some people, it might make more sense for you to be in a strategic allocation. And for a lot of people, it might make sense for you to be maybe in some combination of the two. But when it comes to strategic asset allocation, the investor always has to be tolerant of large drawdowns. And what I mean by that is when the market's down like it was, let's just say in 2007, 8, and 9, and it's down 58%, if the market's down 58, even in a, say, moderate growth portfolio, you might expect your portfolio to be down 40. So you might say, well, I'm down 40%, but the market's down 58. And that might make you feel better, but only if you're the right personality type, only if you're the right type of person to tolerate that kind of drop. Because again, I mentioned earlier we were going to start with the end in mind, and here's how this has to end. Whenever we're building an investment portfolio, it has to be matched to our financial plan, our personality, our behavioral psychology, and our ability to stick with the plan. If we're invested in a portfolio or a portfolio model or a strategy that, let's just say the market goes down 50% and we lose 40%, and we're going to abandon that plan, we call, and say, oh, I can't take it anymore, I'm going to sell everything I own, then you've abandoned the plan, and the financial plan is worthless at that point. So you have to have a strategy that matches your personality type, your time frame, again, your age, how close you are to retirement, whether you're already retired or not, whether you're spending money in retirement, taking money out of your portfolio or not. All of these things are factors, because at the end of the day, what matters most is that you stick to whatever plan you've put together with your financial professional that you work with, your financial team. Because again, I can't reiterate it more. If you don't follow the plan's worthless. So those are the differences today between tactical trend following strategy and a strategic fundamental asset allocation strategy. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, please remember you never ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, please just head over to our website to schedule something in our calendar. As I always say, there are thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates, as well as other screencast videos and articles that we write and produce delivered directly to your email inbox. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koós, as well as Instagram at Financial Surgeon. So again, thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.